Okay, so now we talked a lot about these additions to pay. Again, that's the employer pays those amounts. Now we're gonna talk about these deductions from pay where the employee pays an amount. Cafeteria plans. So cafeteria plans are, again, it's like a contract that the employer has with the employee. The employer provides that contract. They pertain to benefits that are related to health. So like health insurance, dental insurance, life insurance is under that as well. And where the employee can choose between cash or non-taxable benefits. In that case, if there is a cafeteria plan, all of those deductions from the employee's pay are pre-tax, not going to be subject to income tax. Flex spending accounts. This is where the employee has an amount deducted from their paycheck and put aside into a savings account. That savings account can only be used for specific purposes though. There are medical flex spending accounts, and then there are dependent care flex spending accounts. So for example, if I have again, I'll use $1,000 is my paycheck. I have $200 taken out for a flex spending account. That means it's going to reduce. They're taking the money, so I'm not getting that $200. My taxable income now has become $800. So what happens with that $200? I just had $200 taken out of my paycheck. I still benefit from that $200 because what happens is it gets deposited to a flex spending account. This is like a savings account. And now I've got $200 in my flex savings account. If it's a medical flex savings account, that means that I've got now $200 that I can spend. Usually they'll give you a debit card for this kind of thing. I'm sure some of you have maybe experienced this. You can use that $200 then to pay for medical expenses. You have sheltered $200 from taxation. Ordinarily, if you didn't have this and you just spent $200 on medical expenses, more likely than not, you're not going to get any tax benefit from it. Because of the way the tax code is set up with regard to medical expenses, very few people actually get to deduct any medical expenses on their tax returns. But this is a way that you can divert money over to a separate account, use that money for those medical expenses, and you shelter this from taxation. It then lowers your taxable income. Same thing for dependent care. So if you have a child who is receiving, or even an adult, as long as they have meet certain criteria, if you have we'll use a child because that's the most common, a child who's in daycare, and what you can do is divert those funds to another account, and then when you have to pay for that child care, you pay for it from this account. And it then shelters that amount from taxation. Not only does it shelter from income tax, it also shelters it from Social Security and Medicare tax. So like the dependent care credit on the Form 1040, that's great, except that does not shelter that income. That credit doesn't reduce your Social Security and Medicare taxable income. So with these, you're sheltering not only income tax, but Social Security and Medicare tax as well. It's saving you on multiple taxes. So those are the flex accounts you can put in. 2021, it was $2,750. In 2022, it's $2,850. That is going up to $3,050 in 2023. So starting in January 2023, it goes up to that amount. Actually, so this flex spending, that limit is for the medical savings. For the dependent care, I think it's $5,000 that you can put in, unless it's gone up. It may have gone up as well. It's been a while since I've paid for child care expenses, thank goodness. Not cheap. The downside to it is you use it or lose it. So if you have money in this account, so let's say you've done this throughout the year, 200, another 200, and you had a total of $2,750 withheld for the year, but you only spent $2,000. You forfeit that $750. You have to spend it by March of the next year. Now, usually it's not really too much of a problem to spend that much on medical expenses, even when you do have health insurance. A lot of times, so if you've got a teenager, orthodontia is included in that. You could pay for braces with that, glasses, all kinds of different medical expenses. A lot of over-the-counter stuff is also included in that. And you'll see at the end of the year, look around. If you go into Walgreens or CVS in December, you'll see that they have signs up saying, encouraging you to spend your flex spending money so that you don't end up with having to forfeit any of those funds. Okay? Health savings account is the same concept as the flex account in that you divert funds into a separate account and then use those funds for medical expenses. The difference between a flex spending account and a health savings account is that the health savings account, you don't forfeit. It's yours. It's always your money. You keep it forever as long as you don't spend it. If you spend it, then obviously you're getting rid of it. But with the health savings account, you have to have a very specific type of health insurance to pair it with, called a high deductible health plan. Because the purpose of the health savings account is to help pay for those expenses once you get up to your deductible amount. Okay, so if you don't have that specific type of health insurance, then you cannot contribute to a health savings account. You can't have that benefit. With the flex account, it doesn't matter what kind of health insurance, or if you even have health insurance, you can still use it. Okay. Archer Med, I have never actually seen a business using an Archer Medical Savings account, so I'm not sure that they're used all that much anymore. Questions about those types of pre-tax salary reductions? Again, what it does, the employee is paying it, but it's reducing their taxable income. No? So I mentioned these cafeteria plans, and it's just specific types of benefits that are part of the cafeteria plans. They're medical related, well, sort of medical, not all medical related, I guess. They're like lifestyle related. Accident and health insurance could be included. The self-insured medical reimbursement plan, so sometimes companies will, instead of paying insurance premiums, they'll just self-fund, and any types of expenses that come up along the way, they will pay out of pocket for those amounts. They usually hire an insurance company to administer any claims, but if that is the case, those self-insured medical reimbursement plans, group term life insurance is included in this. Dependent care assistance, the first 5,000 of that. So it was, at least when this was published, it was 5,000. And then those health savings accounts as well. This would also include the flex spending accounts. Types of benefits that are not included in a cafeteria plan. Transportation fringe benefits, that doesn't mean, again, that it's taxable as long as it stays under that $270 a month limit. Educational assistance, that $5,250 per year. Scholarships, fellowships, grants, meals and lodging for the convenience of the employer. Dependent group term life insurance, and any deferred compensation except for 401k contributions, those would not be included in that. Excuse me. questions about any of those items? The list of benefits, though, it's extensive, right? I mean, it's not limited to just these items. These are just the most popular types of benefits that employers will offer. Okay, I mean, employers also offer reduced cost stock options. So you can purchase stock of the company for less than the market value. Those employee stock purchase plans. There's all sorts of different types of benefits that can be offered that we're not going to really go over here. These are just the most common. Okay, retirement contributions. So retirement accounts. Remember, I said that usually there's an employer pays portion and an employee pays portion of those retirement plans. 401k, the most common types of 401k plans. 401k, most common types of retirement plans. 401k, which is for private employers, they usually have some type of match involved. So if the employee pays 5% of their pre-tax income into a 401k plan, the employer may match it 100%, so they'll also contribute 5%. Maybe they'll match it 50%, so they'll contribute 2.5%. It just has to do with what type of plan the employer wants to implement. But 401k is that type where there's a sharing of the contributions. Those are used by private employers. 403b, same thing as a 401k, same concept, but it's used, the 403bs are used by public employers. 457b, same type of concept, but they're used by nonprofit employers. They're called this because this is the section of the tax code that describes them, that defines what they are. Okay. There are what's called simple plans. Those are used by small employers that also have a matching component to them. And then there are also other types of plans. Individual retirement accounts, those are funded only by the employee. There are what are called SEP accounts, self-employed plans for self-employed individuals to contribute to. The ones that we're mainly concerned about are these types of retirement plans. So if the employee is making a contribution, they are pre-tax for income tax purposes. They are not pre-tax for Social Security and Medicare tax purposes. You're going to have some problems in your homework where there are retirements that address this very issue. You have to do two separate calculations with regard to what type of income is taxable, or how much income is taxable. For example, so if we've got a 401k, again, our gross income is $1,000. And we have a 401k contribution of, let's just say, $200. Okay. We have to do two separate calculations when we're determining the taxable amount of income. So for income tax purposes, federal income tax, we will subtract the $200 contribution. And again, this is how much the employee pays. The employee is paying $200. So the taxable and FIT is federal income tax. So federal income tax amount the amount that's subject to tax for federal income tax purposes is $800, but for Social Security and Medicare tax purposes, we have no deduction. So all 1,000 is subject to Medicare and Social Security tax. So you have to do two calculations to determine before you figure out what the actual tax is, to determine what your taxable base is. in these calculations. So this is only for retirement plans though. Other types of benefits like health insurance, dental insurance, vision, all of those cafeteria plans, those are pre-tax on the employee side, and they're tax exempt on the employer side. So so for both federal income taxes and Social Security and Medicare taxes. So it's only the retirement plans that have different rules with regard to the taxable amount for Social Security, Medicare, and the taxable amount for federal income tax purposes. Okay, and that we're talking about then the amount that the employee pays. For retirement plans, the amount that the employer pays is not taxable to the employee. It's not added, so it's tax exempt with regard to how much the employer pays. The amount is not going to be added to their taxable income for either Social Security or Medicare tax purposes. There are limits on the amounts that can be contributed to these plans. Those limits change every year. 401ks, 403bs, 457bs have pretty high limits. There is a combined limit amount between how much the employer can contribute and how much the employee can contribute. There are catch-up amounts as well. If you're over 50, you can contribute an additional amount over and above those limits. And there are limits, so individual retirement accounts, as I mentioned, those are accounts that only the employee contributes to. There are limits on how much can be contributed to those as well, either $6,000 or 100% of pre-tax income. So, and there are some income phase-outs. IRAs you cannot contribute to an IRA once your income gets to a certain level, if you're covered by another retirement account. Questions about retirement accounts. The big thing to remember is that difference between how the employee contributions are handled for Social Security tax purposes versus how they're handled for federal income tax purposes. Questions? No? See, all we're doing, right now we're just building up to how much is actually taxable. How much actually are we going to, once we figure out how to do those tax calculations, how much are we actually going to apply that to? So that taxable base. So before we can even get to calculating, we've got to figure out, well, okay, how much is actually subject to tax? And there are different rules for different types of benefits. All right, I'm not going to do that or that. Okay. So we've got some time to actually start this. That's good. This is the one that. Okay, so we're going to look at what's called the W-4 form. So we talked about how do we arrive at the amount that's actually taxable. Once we arrive at that amount, we've got to figure out then how much do we withhold on that, because that's going to vary from employee to employee. It's going to vary based on how the employee fills out what's called this W-4 form. W-4 forms are filled out by employees at the beginning of employment, and they can be filled out at various times during employment. The W-4 relates to how the tax return is filled out as well. So let's take a look at the W-4. Is this and just as kind of a heads up, this is the new form. When we get to the supplement in this chapter talking about the pre-2020 method of calculating pre-2019 method of calculating income tax withholding, the form looks a little different. Okay, so we'll just focus on this form right now though, and get you familiar with it. So there are two parts to the form. Actually, I don't like how this is set up. Let's see if we can find one online. Okay, so technically called the withholding certificate. This is filled out by the employee. Okay. And it's, when they did this new form, it was, I think it is, the withholding is more accurate than it was prior, but they did add some complications to it. They made it a little bit trickier to fill out. The first part, of course, is just the name, address of the employee, their social security number. Next part, box C, is filing status. So if you have filed a tax return in the past, you probably know what your filing status is. However, that filing status can change. We have 5 different filing statuses: single, married filing separately, married filing jointly, qualifying widow or widower, and head of household. These 5 different statuses, you don't really choose what your status is based upon the definitions of each of those filing statuses. That will determine what your filing status is. Sometimes it's really, when you take income tax accounting, if you're going to continue on in accounting, hopefully you will, we go over these in a lot of detail, what the filing statuses are, how they're defined, and they can be kind of tricky. There's some gray area. It seems like it would be easy, and they're basically based on whether you're married or not, but sometimes, because they describe relationships, and relationships are complicated, filing statuses can also be complicated. But in a nutshell, so single or married filing separately. Single means you're not married. You weren't married as of the end of the tax year. So obviously people can get married during the year, right? They can get married. Often, a lot of them do. So that means that your filing status on your W-4 can change if you get married. Maybe you were single before, but then you get married. Now, you might be married filing jointly. You might change that filing status. Married filing separately means that you are married, but you choose to file your tax return, your 1040, separately from your spouse. Lots of different reasons to do that. But you choose to have 2 separate tax returns. So again, it goes back to that 1040, how you file your tax return come tax time. Married filing jointly. That means you're married and you're choosing to file your tax return jointly with your spouse. Qualifying widow or widower. This filing status is for individuals whose spouse, first off, it's only if they have a qualifying child, a dependent. So if you're a widow or widower but you don't have a dependent, you don't qualify for that filing status. That filing status is used by individuals who have dependent children and whose spouse passed away within the last 2 years. After 2 years, you can no longer claim that qualifying widow or widower status. Essentially, it basically gives the same tax benefits for the most part as married filing jointly. Head of household. That is an unmarried individual with a dependent. Normally we think of, somebody with a child, but it's not necessarily a child. It could be a dependent elderly relative, father or mother, that sort of thing. But there has to be a dependent and you have to be unmarried using that filing status. These filing statuses are determined by the employee, not by the employer. In fact, as the employer, you are prohibited from giving any advice. If an employee comes up and says, hey, which filing status should I claim? Talk to your tax advisor. That's the answer. Talk to your tax advisor. For any of the questions about how they fill this out, other than where do I put my name, or what does this word mean, Any questions pertaining to how it should be filled out for tax purposes cannot be answered by the payroll individual. You have to direct them back to a tax advisor. If they don't have one, they can get one. So this has to be filled out. Now there's so this is step 1 up here, personal information and filing status. Steps 2 through 4, and all of these forms, read all of the words on them. Okay, that's my advice when you're doing these in your homework. Read all of the words, because the instructions are there. They're in the document, but you do have to read it. So complete steps 2 to 4 only if they apply to you. Otherwise, skip to step 5. All right, so step 2 is if you have multiple jobs or your spouse works. So if you're married and your spouse works, you need to fill this, you need to read all of this and answer the questions appropriately. If you have more than one job as well, read all of this and answer the questions appropriately. So do only one of the following. First one is you can use the estimator at the email address listed there. The estimator is, although it will give you very accurate information about how much withholding you should have, it is complex. It is essentially like doing a tax return. All of the questions that it asks are like questions on a tax return. It's very detailed. That's why it's very accurate, is because it's asking you for all of the information. I'll let you, I think I've got a link. I don't know if I have a link to this online or not, so that you can take a look at it. You could play around with it, put your own information in there, see what it says. You will notice all of the questions. It's something else. No, it doesn't. But so you see there's six different sections to this. Asks you your filing status. Will you have a yes? And then when you check it, it asks you more questions. All of these things, essentially, and if you look at it, if you've ever filed a tax return before, you can see it is set up like a tax return. All of these different sections asks you about income and withholding, any adjustments to that income, any deductions from it, any tax credits you might be entitled to, and then it gives you the results. It's a lot of information, and you can't just jump forward apparently. But go ahead and play with that. Let's see, let me make this bigger. Whoops. All right, so that's one way you can do it. Another way, you could use the multiple jobs worksheet on page 3 and enter the result in step 4C below. All right, so let's take a look at this multiple jobs worksheet. Here it is, multiple jobs worksheet. So it asks you questions about the 2 jobs that you have, or if your spouse has a job. You just read the instructions and fill out the information. You then transfer what's on line 4 after you've done all of the math over to line 4C. And essentially this gives you a number to be withheld. Now, that works if your income doesn't vary from paycheck to paycheck. But if it does, it can be a little bit tricky. Or you can do step C, which is the one that we're going to do in this class. If there are only 2 jobs total, you may check this box. Do the same on form W4 for the other job. So even if you have 2 jobs, you would check this box for both of the W4s for each of those jobs. You have a job, your spouse has a job, you check this box and your spouse checks the box. Okay? And you'll see what this checkbox means when we do our calculations. One of the factors, there are 4 factors to determine the amount of withholding. One of those factors is the box checked? is there a checkbox? So, your problems will either have the box checked or they won't have the box checked. Okay. Do the same on the W-4. This option is accurate for jobs with similar pay. So if you have a job, you're making $48,000 a year, your spouse has a job making $52,000 a year, that's fairly equal. The checkbox would be perfectly adequate for determining withholding. If one of you is making $48,000, the other one's making $92,000, then you might have to use one. In order to be accurate, more accurate, you might have to use one of these other methods to determine how much withholding. All right, that's step 2. Step 3, claim dependents. If you don't have any dependents, you don't fill this section out. It doesn't pertain to you. If you do have dependents, and again, that's determined by information on your tax return. It has questions about your income. This pertains to the child tax credit. If you claim dependents and claim the child tax credit, it's going to lower your withholding. Child tax credit is back to $2,000 per child, but only for under certain income levels. These are those income levels there. So what it's doing is it's taking into account that your final tax bill is going to be reduced by that $2,000 per dependent. So multiply the number of qualifying children under age 17 by 2,000. If you have 3, you'd put $6,000 there. If you have 4, you'd put $8,000 there. If you have 1, $2,000. Okay, so however many dependent qualifying children under age 17. Then we've got this other dependence amount of $500. This is a separate credit that if you have somebody that does not qualify as a qualifying child for purposes of the dependent tax credit, the child tax credit, they may qualify for this other dependent credit. So for example, if your mother is a dependent and meets the requirements for this credit, you might get a $500 credit for her. All right, so that has to do with the dependents there. Step 4, any other income that you want to have added and included in the calculation for your withholding. So if you've got a savings account and you're making $500 a year in interest on that savings account, you could add the $500 there. And what that does is the calculation then will include that income in the withholding. So it'll increase your withholding and take into account that additional income. If you have retirement income, you could add that in there. And then you don't have the withholding from the retirement income, but it adds that it considers that additional income in the calculation of withholding. Deductions. If you think you're going to claim something other than the standard deduction, most taxpayers claim the standard deduction. Something like 85% of taxpayers claim the standard deduction. But if you're not, there's a separate deductions worksheet that you can fill out right here, step 4B, and you would indicate then, you would fill that out, and then on line 5 here, you would transfer that over here to 4B. And then there's a spot for extra withholding. If you just think it's not going to be enough, you go through all the calculations, and you're like, I know that's not going to be enough withholding. You can add an additional amount. This is per pay period. So, and a lot of people will do that. They'll, add additional $25 or $50 or $100. So you'll go through the whole calculation of how much to withhold and then add just an additional flat amount to that to make sure that you've got enough withheld. Those are the amounts that's how to fill out the W-4 form. Then it's signed by the employee. Again, this is all filled out by the employee. How many employees do you think would be able to fully comprehend all of this information? It's complicated, right? It's kind of complex. Unfortunately, in their efforts to be more accurate withholding, they also added complexity. which is usually the case. When you're trying to be more accurate about something, it means you need more information, right? And that's true of just about everything. All right. This is, I'm not sure what that is. Don't pay attention to this right now. I'm not sure why those tables are there. Probably to give some sort of guidance. So that's the W-4. Again, employees fill these out when they start work. They have to fill them out because the payroll department needs this information. They enter this into the payroll system. They'll enter the filing status of the employee. They'll enter all of these other lines as well with regard to the employee. And then the system will spit out how much needs to be withheld. Now you guys don't get to just spit out, put it into a system and spit it out. You've got to actually calculate it. You need to understand all the components that go into it, and how it's calculated. Okay. Again, these are also filled out anytime there's a change in status. So, for example, employee gets married, they'll change maybe from single to married filing jointly on this form. It's going to change the amount of withholding on their paycheck. Employee has a baby, they're going to add in here a dependent. It's going to change the amount of withholding from their paycheck. Employee gets divorced. Maybe they'll change from married filing jointly to single. It's going to change the amount of withholding from their paycheck. All those different life events that happen change the amount of withholding on employee paychecks. Okay, and would require then that the employee fill out a new W-4 form. Anytime an employee fills out a new W-4 form, this is the form they're going to use. They're not going to use the old form. I'm not going to show you the old form yet. We'll save that for last, but this is the form that they would need to use. All right, so there are 4 main factors. Let me see here. So we went through all of this. Oh, I guess I need to say this. So there is a spot, well, is there still an exempt status spot? Where is it? There really isn't an exempt spot. On the old form, there's a spot for if you're exempt. Whoops, sorry. Where you could say if you had no tax liability last year and you don't expect any this year, then you could claim to be exempt from income tax, and then they wouldn't withhold anything. This was mainly used for like high school students or college students who are still dependents on their parents' tax returns. They have low, they're working in the summer. They don't want to have anything withheld because they end up getting it all back. And in order to get their refund back, they have to pay somebody to prepare their taxes. So if you don't pay in the first place, you're not going to have to pay somebody to do your tax return. So that exempt status would oftentimes be used by those individuals. But that's no longer on the tax return. Employees can change their W-4. We talked about that. So it doesn't have to be on paper. There can be an electronic system that employers can use for filling out those W-4 forms, but they have to provide a paper version if the employee requests it. Kind of like those stupid menus now where you have to use the QR code. Can't stand those things. I always ask for the paper menu. I guess I'm just that old. All right, so employers don't, the W-4s don't go anywhere, just like the I-9s don't go anywhere. They don't get submitted anywhere, but if there's an audit, they have to be on file. Okay, and the IRS will do audits of these. There are penalties for them not being filled out properly or not being filled out at all, not signed by employees, things of that nature. The employee is ultimately responsible for how they fill out their W-4 form. If they fill it out fraudulently, and it happens, they'll claim more dependents than they actually have, or a filing status that actually doesn't apply to them in order to reduce the amount of withholding that they have. That is ultimately the responsibility of the employee. right? The employer can't really police those types of answers for, those types of things for the employees. So that's, the W-4 is used for wages, okay? Only used for wages. Now we have other types of payments that may be eligible for withholding or subject to withholding. Pensions. If you receive a pension in excess of $25,200, there's a form W-4P that's filled out. Payment of sick pay by a third party. That's where you've got disability pay, something like that. You're getting income from the disability insurance company. W-4S. Social Security benefits, you can have withholding from them as well, and that form is called a W-4V. Let's see, what else do we have here? Questions about the W-4? No? Have you all filled out a W-4 in the past? Okay, Kelsey has, yeah. So you're familiar. Maybe if it's been a while though, if you've been at the same employer for a while, you may have filled out the old W-4. Maybe you've experienced filling out both of them. If you had a job before 2019 and then you've got a different job now and you filled it, you updated it, you may have had experience filling out both of those forms. All right. I'm not going to get into detail on this, but I do want to put something up here, the 4 factors that you need to know. Okay. Can I erase this now? You guys have this down? Nobody's protesting. Erase it. Okay. So there are 4 factors that you need to know. And you have to use it. It's working. Four things that you've got to know. First thing, filing status. That comes from the W-4. The employee determines that. Second thing you need to know is the frequency of pay. Weekly, bi-weekly, semi-monthly, monthly. You've got to know that because the amount of withholding is going to vary depending upon how frequently an employee is paid. Third thing you need to know is the amount of taxable income. Per pay. Remember, it's on a per pay basis. So, you would have already calculated any pre-tax, you would have subtracted any pre-tax contributions that were made to different types of benefits, right? Or if there are any additions to pay, the employer is providing some sort of taxable benefit, that would have been added on. So that's when I say taxable pay, I know they say up here, don't pay any attention to this, this is wrong. They say gross pay, it's not really gross pay. It's taxable pay, okay? You need to know what your taxable income or pay is. And then you have to know whether or not that checkbox was checked. Those are the 4 factors that you need to know. There are 2 different ways to calculate the amount of withholding. For both of those ways, you need to know these factors. You'll see when we start talking about the old method, there are still 4 factors, but they're a little bit different factors. And on Thursday, we're going to start looking at how that calculation is done. Let's see here. Any questions? Mm-hmm. Remember, from the employee's standpoint, all of this information is then going to be used when they prepare their tax return. All of the amount of withholding that is done throughout the year is vital information for them preparing their own personal tax return. And the W-4, the information on the W-4 is related to that information on their tax returns as well. It all works together, it all fits together. Okay. All right, well, you guys are free to go.